Welcome to Lesson 8, the Accounting Journal. In this lesson, we will explore the journal and double entry rules. Hello everyone, I'm Professor Matt with the Fundamental Investing Institute. We're continuing our lessons on financial accounting, and in today's lesson, we're going to learn about the accounting journal and the rules of debits and credits. In a previous lesson, we talked about the accounting cycle, which is the series of steps a company takes between recording transactions and preparing the financial statements. Remember that the first step in that process is recording transactions in the journal. The journal is just a worksheet where transactions are initially recorded in accordance with double entry accounting method. The journal contains some key pieces of information: the date of the transaction, the accounts affected, a transaction number used to identify the entry, and 2 columns for recording the monetary value of the transaction. The key to understanding the double entry method and the accounting journal is to understand debits and credits. The terms debits and credits simply mean left and right, respectively. This refers to the 2 columns of the journal where the values are recorded. Now, under the double entry method, every transaction affects 2 or more accounts, and the numerical values of these transactions are recorded in such a way that the value in the debit column is equal to the value in the credit column. We have to understand how debit and credit entries affect the different accounts. The 5 account types we've discussed, asset, liability, equity, income, and expense, are affected by the entries in different ways. There are a few rules that we must memorize. The rules of debits and credits are: for asset and expense accounts, we use debit entries to increase the balances and credit entries to decrease them. For income, liability, and equity accounts, we use credit entries to increase the balances and debit entries to decrease the balances. Let's look at a few quick examples. Suppose a wholesaling company sells products to a customer on account. The transaction affects 2 accounts: sales, which is an income account, and accounts receivable, which is an asset account. To record this transaction in the journal, the company records a credit entry in the sales account and a debit entry in the accounts receivable account. Now, suppose that the same company purchases a piece of machinery for its warehouse and pays cash. This transaction affects 2 asset accounts. To record this transaction in the journal, the company debits the equipment account and credits the cash account. These examples highlight the central concept of the double entry system, that every transaction affects 2 or more accounts, and that every debit entry has a corresponding credit entry. This is what keeps the books in balance. And that's our lesson. To learn more, please visit fundamentalinvestinginstitute.com. And remember to like and subscribe to our channel.